Okay, this is a slideshow I put it together a while ago, which is titled Annuity Decision Tree. So this is sort of the path to figuring out whether annuity is right for you, compared to what other choices do you have, and how do you go about figuring out the right kind of annuity because there's several kinds. So first thing is annuity right for you? Well, compared to what? What other choices do you have besides putting your money in an annuity? Well, we could have investment real estate. Pros and cons of investment real estate. Small down payment buys a large asset because you can finance it. The other pros are you have a long term inflation hedge. The rents can inflate. The capital value of the home can inflate. You have depreciation, which is a tax write off. And hopefully you can get cash flow. 5% generally is a very good cash flow, meaning that if you have $1 million asset, you're doing pretty good if you can get 50,000 a year out of it, clear and free after all the costs of owning the real estate. 8% is probably pretty outrageous. That would be a really good return. The cons on investment real estate is it takes time to pay off mortgages. So you may not be able to capture everything in your own pocket if you finance the properties. And it can take years to get done with finance in order to then capture all of the money on your own. It does need to be managed, it needs to be maintained. The market can suffer a periodic deflation, as in 2008, where property values dropped heavily. That can happen if you're an owner. And it's also illiquid, meaning that if you've got millions of dollars in homes and you need to get it out to do something, you can't get your money right out. So that's pros and cons of investment real estate. Then you have the stock market. Pros are you have periods of strong capital growth, periods over decades where it grows very strongly as just the value of what you own. They are liquid, they can generally be sold very quickly and turn into cash. And you have dividend potential on those. Maybe not great, certainly fluctuating. But if some people feel they know how to work that, they can get payments for just owning the stock and sharing the profits of the company. Cons are it is very volatile. It also does need to be managed, particularly when you're older. You can't afford to be super passive about sitting on stocks, particularly in today's volatile markets. And if you are getting dividends on them, they're not guaranteed. They can shut off at a moment's notice. And by the time that they shut off, that's going to drop the stock price, and then it's hard to get out of the stock and go find another one. You have bonds. Pros about bonds are they are typically a dependable payment. They have to be they're not related to the way stocks perform. Again, that's a whole other lesson if you don't know what a bond is. But they're dependable payments. They're relatively safe for your principal, relatively depending on who's the bondholder. Cons are they are illiquid as well. So you're getting an interest payment, but you can't cash them in at any time. And the interest rates can be dismal. Depends what environment you're in. When I did this slideshow, interest rates were at the bottom. So they were very dismal at that time. They've come up since then here, getting closer to 2004. All right, so you can mix and match, but you still need a method and you still need a plan. So you can, there's many things you can invest in, but you still need a method of how you're going to go about it, and you need a plan on how to mix and match it. All right, so compared to what? Another offering, another thing that's out there. It's just doing comparatives before we jump into everybody should own an annuity. What else is out there? There's private offerings. They're in vogue at the time that I've made this slideshow. That'd be commodities and uh, commodity producers, which is in this case we're looking at oil. Oil shares. That's another one. That's kind of I think what I was basing this on. They do have great earning potential. Uh, Oil, particularly, and depending on what you go into, minerals. There's a whole mineral deal that has great tax savings potential, where the minerals are eventually donated to charity. It's a whole gambit of how it runs, but there's a million different private offerings. It can be equity, meaning you can own part of it, or it can just be debt where they owe you a payment. There can be some exceptional opportunities. The cons are you can lose your money in them. And I've seen some of the best ones for years do great, and then the money was gone. Like one year they just decided, oops, the thing failed and people didn't get their money back out. It can happen. It takes a lot of research. Private offerings take a lot of research to be involved in. They are less regulated, very, particularly if you have $1 million and you're an accredited investor, all bets are off. It's almost like the Securities and Exchange Commission feels like you got enough money. We don't even need to look after you. You're on your own. Um, companies also. So there's private offerings in commodity projects like oil, gold mines, things like that. There are also private offerings that are just ownership shares of companies. Pros are great earning potential there. And this is like where a company says, we're taking off, we're going to do all these things, we want you to invest in us, but we're not public, we're not on the stock exchange, we're not filing a whole prospectus with the SEC, Securities and Exchange Commission. We're just, since you have $1 million, we can talk to you direct and ask you to give us money. There can be some tax savings potential in investing in companies on private offerings. Again, they may offer you a share of the company as equity. They may offer you just a bond payment as debt. There can be exceptional opportunities. Cons are you can lose money. Takes research. Less regulation. How about that? Same as the others. So there's that. Now, what you want to ask yourself is what is the goal here? So before you look at all these choices, stand back and say, what is your goal as an investor? Are you trying to grow capital? Are you trying to generate income from it? Are you going for the tax savings? How do you feel about safety versus risk? And are you trying to make sure that this passes on? These are just all, they may or some of these goals may be pertinent to some investors. They may not be pertinent to others, but these are the type of things that you really need to start with before you start looking at where should I put my money? What do you want your money to do? Is capital growth important? Is income important? Tax savings, safety of your money versus risk of your money, legacy going to the next generation. It's all things that you need to consider to figure out where you should put your money. Also, you might consider what kind of professional you want to work with. There are brokerages and there are fee for service financial planners. Okay, these are a couple ideas. A brokerage is just someone who's going to buy and sell mutual funds and stocks for you. They're just going to take your order and get it fulfilled. A fee for service financial planner is going to charge you to put a plan together. They're supposed to be fiduciaries, but it's no telling that their judgment or their call is any better advised or smarter. They just believe that they're working in your best favor. Are they going to go out and tell you to make something that's going to go invest in something that's a long shot that's going to make you millions? Probably not. It's a liability. But could there be someone very informed about that? Yeah. I'll tell you also with financial planners and what I work with in insurance products, I specialize in looking at insurance products, annuities, and life insurance. I just know a lot about those different products. I know in and out of them. I know which companies are making promises work and which ones aren't. A financial planner fee for service person, they don't comb as deeply typically. Their thing is charge you for making a plan, putting a plan together, but they may not be as informed on product selection once they go into implementing the plan. That's typically a weakness for them. Well, maybe I gave these slides away already. Pros of a brokerage: big growth potential on good years. You've got a universe of choices: stockbrokers or bond or stock brokers or mutual fund brokers. Liquid money there can be liquid. They can get you in and out pretty quick. They may be a fiduciary. They may be a brokerage and a fiduciary both. Cons are typically you're going to have some kind of transaction fee at a brokerage. You could lose your money. They're putting you in securities. If you're in securities, you could lose money. There could be management fees with no guarantees. In other words, they could say, we will manage your money for XYZ amount, but were you not going to guarantee anything if you lose money? Oh, well, you still owe us our fee. And their advice can be tainted. Even as much as they may advertise that it isn't, That's a hard line to draw on what's tainted and what's not. And the same goes for fee for service financial planners. Now, their pros are they're going to work up a comprehensive plan for you. They might not charge for brokerage or management. So they may execute trades for you, but charge you for the plan and not charge you for the transactions. They may be a fiduciary. In most cases these days, they are kind of leaning that way. But their advice should never be tainted. That's a pro that it should never be, but it's also a should. Cons. You might pay just to get a plan. In other words, you got a plan, now you got to execute it. Well, you just paid for the plan. Nobody's executing it. That can happen. There's no guarantees. Just because they put a plan together doesn't mean either their plan is guaranteed or where they're putting you. Where they're placing your money may not have guarantees to it. Also, it might be risky. You could lose money with a planner. You could lose money with them. Just because they put a plan together doesn't mean you can't lose money. Their management could be is usually annual, or transactions may incur more fees. So look out for the fees, how many places you got fees. Those are just two different types of professionals, period. Not saying one's better than the other. I'm just saying these are things to consider when you're considering where you're putting your money is what kind of professional do you prefer to work with? Multiple fees, fund managers, transaction sales fees, mutual fund fees, fund expense fees, all drawn against client accounts. So, thing to know about fees is a fee is something that is taken out of your account. It is accounted for. You have your money in an account somewhere, and then someone is drawing it for particular reasons. It might be a transaction, it might just be a fee on the sale. Mutual funds will have fees on just managing the mutual fund. All these things come out of your account. And technically, that's what we define as a fee. All right, now let's talk about what an annuity is. An annuity is a contract. So the pros of an annuity are uh, often you can get greater income from an annuity than you can a typical stock portfolio. Hopefully, these slides will explain why. If not, I will get to it. But annuity is a contract with an insurance company where you deposit your money in an account and they will pay you an income that's typically guaranteed for life. It has potential for growth, so it can grow when markets grow, but the ones that we work with are also safe from market losses. So your gains can be tied to be very aggressive with market growth, but we make sure that there's no downside where you could lose money. You can never run out of money in an income annuity. If it's geared for income, then you can go to zero, and if you're still standing, they still have to pay you checks for your income. They are done for peace of mind. That is the main reason people hold annuities. They are not volatile investment portfolios. They are done for peace of mind. Cons. They are typically conservative growth. That's a relative thing, but typically they're not super aggressive growth. Although I've got companies, I could show you there's an although on any of these. Any of these points throughout this entire presentation are going to have an although. So annuities are conservative growth, although I've got them that have done 17 and 19% on some years where that couldn't be taken back, where that was a locked in result. So exceptions to everything. Annuities are long term and they have liquidity limits typically for a number of years where you can't just turn around and put your money in and 6 months later take it all out. You can't do that. They tend to be long term contracts. Annuity agents, how do they operate? Pros are they typically do not have fees. There's not a fee that comes out of your account for an annuity agent to use an agent. Now, some annuities, variable, not fixed so much, but it depends. Some annuities may have fees in the product lineup, but typically an annuity agent is not taking money out of your account to be recompensed. They may do education, planning, illustration, and research at risk of no sale. So, an annuity agent will invest lots of time and effort into making sure you understand your choices, kind of like what I'm doing here, at no risk, at the risk that they may not wind up with a client at the end of the day, but it's part of what they do. It's very typical. They typically know their speciality better. So that's what I was talking about earlier. It's like I've got fiduciaries, financial planners, and they will recommend annuities at times, but they won't give you a half a dozen choices and break it down into minuscule pieces because they're not specialists in that area. So they get kind of what their brokerage or what their supervisors tell them to put in front of people, but you couldn't ask them to break down typically five different models and why one model excels over the other in different ways. An annuity agent will probably be smarter about product choice. They can work with small clients. This is a big thing that's going on with the fees these days. They're trying to push everybody into fiduciaries, but man, if you don't have a lot of money, a fiduciary doesn't want to take you on because you got to pay them a fee and it's got to be a large enough account. And if it's a tiny account, they don't make much. But an annuity agent figures, look, if I'm making even a few $1,000s, it can be worth the time to work with small clients. And if they're working in fixed products, they can't lose your money. That's another pro. The cons are they may be biased. They may love their products. They may like the commission they get on those products. They may, and by the way, brokers and other people like their fees too. So, an annuity agent has no fees. They may not show you things that have fees because they're going to just kind of be biased maybe towards their no fee products, but they're going to get a commission. They may not know other fields. They might be undereducated when it comes to securities and other things. So they're going to know their speciality. They may not know other fields. This is another thing you want to look out for part-time annuity or insurance agents. A lot of them are working multi-level these days, which means they have a day job. This is their night job. So they're also not our experts. WFG kind of works with a lot of these part-timers. All right. So let's say that you decide you like an annuity agent and you like the annuity product. Now, what are your decisions in terms of going down to what kind of product are you going to work with? Well, the first question is, have you actually done a retirement roadmap or income analysis? This is the looking at the big picture. We always start there. We want to try to do what is the big picture? Like, why are you even looking at an annuity? Do you need income? Will you have future income? Are you all at risk? Do you need to pare down your risk? Or are you just buying a shiny object off a shelf? That's kind of stupid. Sorry, I wasn't going to be derogatory on this, but I don't believe in getting shiny objects off a shelf because they sound good. You want to go back and go, what is the basic analysis that the need for this product stems from? And how much of your total portfolio do you want for other potentials? This is an important part where I get people they go, I really like an annuity, I really want an annuity, but I don't know how much I want to spend on it. Okay, good. So work it backwards and say, how much of your total portfolio do you want for other potentials? And that informs us what you've got left that you could put towards an annuity if you've decided that that's potentially what you want to be doing. What else we got here? Why clients don't like me to solve all their problems. All right, this is just something that was a little bit of a side. It's a personal note, which is that I used to have, let's see what this first slide is. Yes, I used to have clients that would come in with their status quo. Here's what I've got. I'm afraid I don't have enough money for retirement. I would like someone to really, really figure out how I can have enough money for retirement. How can I have enough income, keep up with inflation, keep my money safe? I want all those problems solved. So you go from implementation, from status quo to implementation to future realization. All right. So they want that future realization. They want me to take them from status quo to an ideal scene. I can't remember what's on this slide. All right. So when they're doing that, and this was the thing, I used to get people where I would do a complete model. I would fully bring them to the future realization you can do this. Here's how you can do it. Here's how you can make it happen. And I would go 100% in on the solution and they would run from me. They'd disappear. They'd ghost me. I'm like, what is going on? That I'd made a perfect plan that was 100% in the right direction and they left because going from status quo to the future realization is change. It creates change and people can't tolerate 100% change. So when they go from change to implementation, That's more change. When they go to future realization, it's even more change. The point is, they can't take that much change. You can't move people from status quo to future realization to perfection. You will scare the dickens out of them. So you don't do that. So when you work with us, it's too much change too quick. That was the point of that last slide. I like that one. Let's go back. Too much change too quick. So when you're looking at going into something like this, you're probably not going to put all your eggs in this basket. So what do? The answer is you go incrementally. You do a small amount that you're comfortable with, that you can sleep with at night. You have $1 million portfolio. Maybe your whole $1 million would be great going in one direction. Don't do it. Take 250 and just execute that. See how it feels. Come back to it later. And then if it feels good and you feel like you've done the right cycle, you can do it again and you can do it again. That's how you keep from getting frozen. But when it's too big of a step, people freeze. They can't make decisions. Make smaller changes over time. Leave room to adjust your course as you go. That's how we operate with our clients. Anything else I want to say about this? How to pick an annuity product. Okay, a couple other things here. I think I have other videos that also go over this. How to pick a product. You're going to be picking for either maximum potential, which is a growth, like growing your money. You just want to grow your money, or maximum predictability and longevity, which is going to be an income annuity. So these are two different types. One is just grow the money. I'll figure out how much I can spend and how often I can spend it. And the other one is, let's make this so I can spend it forever. And even if I run out of money, I won't, even if the account goes to zero, I'm still going to get income from it. Now, when you go for income, there's two ways to take income. You can maximize it as a level income. It's the same payment every year, every single year. That's a little risky for inflation, but it will give you a higher payment. You can take increasing income, which is great for inflation, where your payment goes up every year, but it's going to typically start lower than the max payment will be. So the level payment. So the level payment will be maximized. Increasing will start a little lower. If you just want growth potential, it's really simple. There's no fees. It has less potential for income. Well, that's not true. This is going to be covered on other slides, so bear with me on this old slide. But the point is, we can enhance features, may or may not include fees. We can enhance growth. This is just gunning for extra growth. We can get extra liquidity out of some of these. I'm not sure. I was thinking about some product choices at the time. We can get accelerated growth potential, but typically nothing on these annuities are going to protect your income. So once you start drawing down, if you draw it too fast and it runs out of money, you're just out of money. It may grow more money for you to withdraw from, but there's no protection on the withdrawal. On the income annuities, if you withdraw money and you do it under the terms of the contract, and it goes, you live a long life, and you empty the contract, they will still make your payments. That's pretty much it to know about the annuity decision tree. I will give you more about growth versus income in a later video, and we'll talk more about level versus increasing income in a later video.